Pro ran the most successful independent presidential campaign in modern history based on largely debts and deficits in the early 90s. That period was kind of the peak zeitgeist for public concern around the debts and deficits. But the phase we went to for the next 3 decades was that China opened up to the world, Soviet Union fell, basically large amounts of labor and resources got connected to Western capital.
Investment strategist, macro analyst Lyn Alden is respected in the Bitcoin and cryptocurrency community for her ability to demystify difficult subjects and her deep understanding of macro concerns and how they affect asset prices and the economy. Each tweet displays her knowledge and admiration of blockchain and Bitcoin technologies. Reasons our financial system fails: how to improve. Alden examines how the broken global financial system impoverishes billions while enriching the top 1%. Alden also stresses that our monetary system is outdated and flawed despite plentiful resources and technology that have improved our lives. Despite medical advances and moon landings, our debt-based fiat economy is crumbling. Book back cover description: each of 160 currencies is monopolized locally. Most currencies devalue quickly and are rarely accepted abroad save for the top dozen due to cross-border frictions, bottlenecks, and currency exchanges. Due to global financial system barter, being born abroad makes saving money impossible. Lyn Alden predicts that the US dollar and other major currencies will outperform weaker currencies, which will crash and weaken. The US dollar may follow the Bolivar or Lebanese pound. This is why sound money. Alden recommends replacing our debt-based, inflation-prone monetary system with a powerful digital network that promotes scarcity, deflation, decentralization, and frictionless payments. Bitcoin fits all principal crypto criteria. Growing worldwide popularity and a grim economic picture. Alden expects Bitcoin use and prices to soar as the US and world approach a Bitcoin standard. Alden just spoke with Prof. about Bitcoin stablecoins and cryptocurrencies. Follow the channel, like this video, and enable post alerts for more. All your YouTube algorithm-friendly behaviors generate channels.
Companies at reasonable prices based on their fundamentals for the long term. Over time, I've looked at multiple different investment strategies. Value often has the kind of perception that it is opposite of growth, that basically it involves kind of lower growth, cheaper companies, where I think a more holistic understanding of value investing is that basically it's fundamental investing. So that can include a growth company as long as you're basing your research on the fundamentals of what you expect the company to do, rather than say purely chasing things like price. And Peter Lynch really popularized that strategy back in the 80s, like growth at a reasonable price. That's basically that could be kind of the intersection between growth and value investing. In recent years, I've incorporated more macro analysis into my investing frameworks because I kind of started to view back in say 2017, 2018, that this was to be like a macro heavy decade, which means that things that are outside of any one company's control will move a large portion of the market. So I do incorporate kind of a macro overlay that helps me determine potential growth rates of companies and things like that. But yeah, at the heart of it, I like to buy profitable companies at reasonable valuations that I think are going to be providing a good product or service over an investable time horizon, 3, 5, 10 years, and then let that thesis play out over the long term. Piece of it is the fiscal dominance, is how I would phrase it, that most of the past, call it 40 years of investing history, was under a period of monetary dominance, which we can think of as central banks and commercial banks having a very big influence on markets. And so most economic expansions are these periods of heightened bank lending activity. And then most of the recessions are periods where banks are pulling back their lending, and often because central banks are tightening for various reasons. But there are other periods in history where the fiscal side becomes as big or sometimes more of an important variable than the bank lending side. And so, for example, if you look at annual net bank loan creation and you compare that to annual fiscal deficits, in most decades, the bank lending would be a bigger sum than the fiscal deficits, especially if you also add corporate bond issuance, net corporate bond issuance. So basically, how much kind of private sector lending in various forms, either securitized or not, is happening compared to the size of the fiscal deficits. But the 2020s, and really kind of even like the year kind of leading up to that, like 2019 or so, we're now getting to a period where the fiscal deficits in a given year are bigger than new bank loan creation and bigger than even the sum of bank loan creation and net corporate bond issuance. And the last time that the US was in that situation was really the 1940s. So it's a very long term historical kind of framework. Japan finds itself in that position today. And in that kind of environment, you tend to, on average, run inflation a little higher than you would otherwise. You tend to have a little bit less cyclicality in markets because you have this background deficit spending that's happening. And you tend to get bigger bifurcation between different sectors. And so, for example, in the, say, the last year, if you're on the right side of fiscal deficits, meaning, for example, if your business is catering to recipients of Medicare, Social Security, defense, your business is doing pretty well. Like if you're in the travel, hospitality, restaurant business, you're doing fairly well in this environment. Whereas if you're not really on the right side of fiscal deficits, if you're more impacted by the monetary situation, like commercial real estate, for example, then you're in an outright depression. And so you get when you have that kind of tight monetary but also very loose fiscal policy, you get into a very bifurcated type of market. And so that kind of led me to say be less bond focused, more equity focused, and to make decisions like that for my portfolio. And some of those have played out far more usefully than say avoiding one company or picking another company. Having those kind of big asset allocations reasonably correct has been a huge source of risk reduction.
Though currency debasement hurts emerging economies the most right now, Allen thinks it will only be a matter of time before it affects many other developing economies, from Nigeria to Egypt. Lebanon, Argentina, there is terrible inflation in Sri Lanka and Zimbabwe, and currencies are falling in value at unbelievable rates. For example, the Venezuelan bolivar has lost 99.999% of its value against the US dollar in the last 10 years. This means that people who saved in that currency have almost no value left after 10 years. In her book, Alden also talks about Nigeria, where inflation has reached a 28-year high of 33.95%, and the Egyptian pound, which is one of the worst performing currencies right now, according to Alden. In just a few years, this could be the case in many wealthy countries that print excessive amounts of money, as Alden and other sound money experts say. Supporters have been saying for years that the issue is quickly spreading to the developed world, as shown by Japan's recent worsening economic conditions. On Wednesday, the Japanese yen hit a 37-year low against the US dollar, adding to worries of an exploding debt bubble that will surely affect other developed economies, such as the US. Let's go back to the talk with Alden.
There's an interesting trend that I think led to this, and I agree with you. When you see people today talk about the risks of the debt and the deficit, you often see the response to that is people said, "Well, people have been concerned about this for decades, and look, nothing bad happened." And it's funny when you look at when the national debt clock went up. That was the late '80s. Ross Perot ran the most successful independent presidential campaign in modern history, based on largely debts and deficits in the early '90s. That period was kind of the peak zeitgeist for public concern around the debts and deficits. But the phase we went to for the next 3 decades was that China opened up to the world, Soviet Union fell, basically large amounts of labor and resources got connected to Western capital, a big burst of globalization, very disinflationary. And so we kind of had this period of 30 more years of falling interest rates, and that offset a lot of our public debt accumulation. So if you double your debt but you cut your interest rate in half, your interest expense still seems quite manageable. And I think people got lulled into a false sense of security that they kind of said, okay, we were worried about the debts and deficits. It turns out we didn't have to worry. We're fine. And then now people kind of, I think, the pendulum swung the other way, that people are saying, look, what we've learned is that they don't matter. But I think the key risk is that our interest rates they bounced off zero. They're now going sideways to up. I think we're in a structurally like no longer declining interest rate environment. And when you have accumulated debts and deficits and interest rates are just going sideways, let alone up, that offset's gone, and the debts and deficits actually start to matter quite a bit more. And then, as I said before, when that sum of fiscal deficits is larger than the amount of net bank loan creation or even the sum of net bank loan creation and corporate bond issuance, um, that's just a much bigger factor on the economy. And then in addition, you can get to a point where the Fed rate hikes they lose their effectiveness to fight inflation. Because if you have an environment, let's say back in the early 80s, where public debt is 35% of GDP and most of the money creation is coming from bank lending, if you raise rates super high, you do blow out the fiscal interest expense to some extent, but you put a lot more downward pressure on that private sector lending. And so that tends to be a net disinflationary effect. On the other hand of the spectrum, if you have fiscal deficits are larger than bank lending, and you have an accumulated stock of over 100% debt to GDP on the public ledger, when you raise interest rates.
It might not be clear right away because people in emerging markets with weaker currencies can still temporarily rely on stronger ones like the US dollar. However, these supposedly strong currencies are also being destroyed by inflation, though at a slower rate. Eventually, as more money is printed to cover huge debts, inflation will speed up to the point where even the dollar can no longer be trusted to keep wealth safe, according to Alden. This tipping point will happen much sooner than most people think it will, and when it does, the world will turn to Bitcoin as the best way to save money and get rich. Please share your thoughts on Alden's interview below, and don't forget to give this video a thumbs up. Follow the channel and turn on post notifications to see more movies. Thanks for showing up.